Hello and welcome to the Weekly Watch podcast series. I'm Giles, Gale, Head of European Rate Strategy at NatWest Markets. This series helps you to cut through the noise of global financial markets with a quick take on the upcoming trends to watch. So here we are now in the second half of the year. I'm going to have to resist the temptation to do too much of a look ahead today because our economics team is currently preparing their big third quarter stock take and forecast refresh. So we'll probably be talking about that more next time. But I will just highlight a few of the key themes and changes because we've also just published the abbreviated release for the for G3 forecasts. Overall on that, we are still pretty upbeat on growth with 5% GDP growth for the euro area, 7.1 in the UK, and maybe fairly astonishing 9.3 in the US for this year. We're not looking for that necessarily, though, to be especially for inflationary. And I have our co-head of economics, Michelle Girard, with me to talk more about how she feels that is panning out for the global picture in a moment. So I'll leave that comment there. The other, I guess, change is that we're dialing back our optimism a little bit on emerging markets going into the summer. And just to sketch that, we think that the good COVID stories may be turned for, particularly for some Asian economies, and trade balances are peaking. There's a number of other things as well, but I won't go into the details of all of that right now. Data momentum, I think it's important to say, has also been especially strong in the euro area over the last week, where we've really had a purple patch of upside surprises from business and consumer surveys, all really surprising on the strong side of already very high expectations. This week, on the political side, the story was the breakthrough last week, I suppose, for the bipartisan deal on infrastructure spending, which may be completed before the August recess. There are some risks there still because Democrats are demanding to go ahead only with some Democrats anyway, demanding to go ahead only with a Democrat-only partisan social package in order to make sure that they keep the centrists on side for that. But it looks promising and maybe makes July a little bit more interesting for fiscal policy than we thought, particularly with regard to the social package that most people still have in mind for after the summer, which would be a much bigger deal for the markets. I think it's just important to repeat that this infrastructure deal, it's not a deficit finance mega package. It shouldn't have any impact on this year's budget at all, in fact. So I'll just finish by saying that the start of July, we're already looking ahead to summer conditions. From conversations with investors, it seems that expectations are already set for a fairly quiet July, and maybe that's right. Seasonally, July is often quiet, and positioning does seem relatively light again from the feedback that we've been hearing. But we're also aware that there's a lot of unresolved issues for the second half, which are likely to come back sooner rather than later, we think. So maybe we're not looking for a quiet August as well. And the first is maybe we have to watch what's happening with the spread of the Delta variant and travel. And in Europe, where I sit, that's certainly a focus because holiday travel is such an important issue. In the UK, we had a very close look at the data because obviously it's such a problem in the UK at the moment. And overall, the evidence that we see is that vaccinations do mean that infections tend on average to be significantly less serious. So, unambiguous good news there, I think. And the EU, well, it's behind the UK on vaccinations, of course, but it's also about as far behind in the spread of Delta. So, at this point, we're relatively optimistic that that's a risk that can be contained. The other risks, I imagine we'll come back to those in weeks to come, so I'll just list them. We have the inflation transitory or not debate. Now that's going to be ongoing, and the next important date that we have with significant data on that is actually tomorrow with payrolls. And by the time you actually listen to this, that will have come out, and you'll know how that's gone. We also have the equity earnings season later this month and Jackson Hole in August, and an important series of central bank meetings on QE tapering and so on from September. And in September, we also have German general elections and the Angela Merkel transition. So, it's pretty clear, I think, that there will be plenty of reasons that we won't be stuck for things to talk about. So with that, I think we will get on to inflation and Michelle. So Michelle, inflation metrics surpassed expectations for Q2 2021. I guess fueling concerns that surging domestic demand has ignited long dormant inflation pressures. What drove the recent increase?
Well, we have seen a surge in inflation. At NatWest, we have a developed markets CPI measure that we track, and the headline measure 3.5% year over year is the highest since 2008. The core CPI measure that we follow for developed markets is at 2.2% now. It's the highest in at least 2 decades. We've done a lot of work in tracking what's driving it, and we had published a global inflation piece a couple of weeks ago that details this work. But breaking it down into categories that are COVID impacted, if you will, versus those that are not, it's very clear that this recent, upsurge, if you will, has really been driven by the rebound in COVID impacted categories, those areas that had been so depressed as a result of lockdowns during the pandemic, all coming back. The non-COVID impacted core categories or core metric that we follow is actually moved down. So it is at the moment very concentrated in areas where you'd expect to see the most price pressures as economies have reopened.
Okay, and so I guess that brings us to the really big question. Do you think that that gains are transitory or more lasting?
You might think, right, if it's really coming from just the COVID rebound, that would make it more likely that it is transitory. I mean, one thing I would point out is that shortages and bottlenecks that we are all aware of are happening globally have actually led to an increase in the most recent months of prices away from those COVID impacted categories. So we have seen a bit of a broadening out most recently. And that suggests to me that some of this acceleration might be sustained longer than people would like. So overall, yes, we think the magnitude of the increases are transitory. But we have inflation coming off over the second half of the year, but we still have that core developed markets measure holding above 2%, at the end of 2001. And so again, the magnitude of the reins is transitory, but overall, inflation may remain firmer than people might expect.
Okay, so where do you see the greatest threat for inflation?
Well, not surprisingly, given that this is where a lot of that COVID rebound strength has come from, it is the U.S. where we see the greatest inflation risks, and really most of the gain in inflation that we've seen globally is at the moment emanating from the U.S., where of course fiscal policy has far surpassed what we've seen elsewhere around the globe.
Okay, and what does that all mean for the response of policymakers, in your opinion?
Well, so obviously that's been, I knew that was going to be the next question because that has obviously dominated market attention in recent weeks. Will central bankers begin to think about raising interest rates and reversing course sooner than anticipated? I just will focus mostly on the US where, as I said, the upside risks exist, and clearly there with the Fed shift to a framework of allowing an inflation overshoot, really institutionalizing that. We do think that the Fed is going to stay patient. I know markets are worried about action sooner rather than later from the Fed, given the outcome of the dots in the last meeting. We still think near-term action or move in 2022 isn't likely. And then in Europe and the UK, where actually the inflation risks are more muted, you're not likely to see a change in framework. We do expect there too, policymakers will indeed be very patient.
Well, thank you very much. A model of clarity as always.
Thanks, Giles.
I hope you've enjoyed this episode of The Weekly Watch. Please subscribe to our channel to get future episodes. We also encourage you to explore more of our content on our website and other social media channels.